Good morning, guys. So I want to address a question that was asked by a gentleman in the Patreon. And I think it's worth going over this and just putting this into perspective for all you guys that have been with me for a while and for anybody new that's passing through to the Patreon. So in front of you, I've got Euro, Dixie, Aussie Yen, and the S&P futures. Okay. Now, the question that I'm referring to is this one over here. Heart Pumper said, Tino, I know I'm asking for Markets 101 Pure Basics, but I couldn't find it yet in a consistent video. I know you're talking about it frequently during live streams, but can I ask one video, short one's good enough, explaining all connections between cash, asset, baskets, indices, about that liquidity flow in the markets, offloading one to buy another, traditional safe havens, currency pairs, one going down, the other profiting on it. I wish someone would make a PDF. Well, here it is right here, my friend. So, when you start your trading day, if you have not that much of an understanding about what you're looking at, there's no point in even considering what we're doing right here, okay? But just the best way for me to explain this to you is like this. Imagine you've got $100. Now, what can you do with those $100? You can go to a shop and buy a tangible asset, like you can go buy eggs, for example, and that $100 will probably get you 5 eggs, okay? But when it comes to the marketplace itself, Forex is all about exchange, right? Money markets are effectively, how do they move exposure? So, for example, if euro is going down against the dollar, simply the dollar dominance or the value of the dollar is going up because they're transacting more on the dollar as opposed to transacting on euro. Likewise, when you see the dollar dominance going up, there are 2 scenarios that you have to take into consideration. If dollar goes up, it's usually good for the S&P and the NASDAQ. Why? Well, look at it like this. Just to break it down simply for you. S&P and NASDAQ, they will rise along with the dollar itself. Okay, so when dollar goes up, NASDAQ and S&P in principle should be going up. All right. Now, imagine companies in the S&P and the NASDAQ that rely on imports. Okay, so it's good when companies receive imports. All right, when the dollar is strong. Now, companies that sell their products globally, for example, it's beneficial for them for the dollar to be weak. Okay. So what does that mean to us? Well, when the value of the dollar is being used, so when people, foreign investors use dollar, they're going to do one of 2 things. Buy treasury bonds, they're either going to buy the stocks, they're going to get involved in the indices. Ultimately, anything related to the US dollar is going to be shown in the dollar dominance chart. It hurts companies when the value of the dollar is strong. And that's for those guys who export. That's why the Japanese yen needs to be so low because they rely heavily on exports. If their yen is strong, it doesn't serve them because in principle, it's costing exporters more money to pay. So the weaker their currency is, the easier it is for foreign investment to pick up stuff from Japan at a lower rate. Okay? Now, how does that affect trading? Well, all you need to do is just look at the chart. We've got a situation right now where dollar itself is up, but the S&P is down. All you need to do is just look at the peak from where S&P peaked out right here and look at the dollar dominance chart. Just look at everything across the board. Look at the middle of the Aussie yen and euro. When I put my cursor above here on the S&P, look at where it marks off on all of the assets in front of you. So I'm going to do it for you now if it's harder to see. There we go. That will put us right here. Okay. And then we look at the dollar and we assume that that zone was there. Okay. So pay attention to the arrows in front of you. You can see that dollar is going up, euro is going down, Aussie is going down, and S&P is going down. So what does that tell us? It tells us that although they are transacting in dollars, the dollar value is going up, but assets across the board are going down because people are going into cash. So that means there are more dollars being held, okay? Which is why dollar is moving up. There are less dollars being put to work, okay? Now, why is Aussie yen important? Because Aussie yen works on the principle of the carry trade. So quite simply, the carry trade principle is as follows. Investor, he wants to diversify his portfolio. He wants to get involved in a little bit of action, okay? So what does he do? Well, he's got the luxury of using either dollars or yen. So that's what he has, all right? He will take a low-yielding asset like the dollar or the yen, and he will go to a high-yielding asset, which is the Aussie dollar. With that Aussie dollar, he will then go and buy stocks, commodities, forex, and bonds. So if he goes and gets dollars, okay, and he exchanges them for Aussie, that in principle decreases the value of the dollar, increases the value of the Aussie. So you expect dollar to go down and Aussie to go up. At the same time, you'll see stocks and commodities go up, okay? Likewise, when stocks and commodities going down, Aussie is going down because the investors that have made their money exchanging Aussie into stocks and commodities and using that to buy these stocks and commodities, they sell their Aussies back into dollar, which in turn releases the value of the dollar to go back up. Okay? This is what we call the carry trade principle. Now, it does get a little bit confusing because you're like, hold on a second, Tina, how does this help me trade? Well, this is like a fundamental understanding of the carry trade principle and how the value of certain assets going up against the dollar and the value of the dollar going up against everything else and how that's going to help us understand where we are in the marketplace. Okay? So we look at this chart, Aussie yen. Can we safely assume that on the 1 hour time frame, Aussie has been moving up? Yeah? Well, let's just go on a higher time frame to just make the chart look clear. What have they been doing? They've been picking up Aussie. We'll go even higher. Let's put it into that perspective. For the best part since 2020, they have been buying stocks, okay? Because it's been going up. There's been profit taking right here. There's been profit taking right here. And there's been profit taking right here, which happens to be what? It looks like it's the formation of a level. We have got W formation, rise up level 1, retrace, rise up level 2, retrace, rise up level 3, peak formation. Drop level 1, drop level 2, drop level 3, peak formation. So we are in a cycle right now of selling. That's what this is showing us, okay? On Aussie. So we in the back of our minds know that in the bigger picture, Aussie looks like it's getting ready to sell off, okay? Now, if we zoom in closer from technical analysis, we can say, okay, maybe it looks like it's trying to hold out in this area. We've got some vector candles up here that we can be thinking about. But from face value, it looks like they're forming the start of a level 1 drop, continuation down to go level 2. So in my mind, I'm visualizing that the value of the dollar is soon going to continue higher because they're starting to get rid of Aussie. That means they're going to start exchanging their stocks, selling their stocks, okay? Selling their stocks back into Aussie and then back from Aussie back into dollar or yen, whatever it is they chose to get first. Predominantly, it's always going to be the dollar that they transact on, okay? So with that being said, right, how is that going to help me trade the charts? Well, then all I need to do is start off my day by looking at Aussie and say to myself what kind of flavor they are in. Well, Aussie is going down, okay? So I look on the charts over here and I say to myself, right, let me look at the S&P. How is S&P faring in relation to Aussie, right? So I'd get rid of all of this. And then I'll add to the chart Aussie yen, AUD, JPY. And then I will think, okay, where are we at? Well, it looks like they're moving exactly the same. I've got exactly the same chart. Yet, Aussie is a little bit more volatile than the S&P, which means that when Aussie is dropping down, don't think that they're getting rid of everything and then it's going to the pits. It's just consolidation, taking profits, adding positions, and loading up again. So you can use the Aussie chart to gauge the idea of how likely S&P is going to keep moving up, or the idea of the idea that the carry trade principle is going to be continuing. Because as Aussie is going up, so is the S&P. Now, remember, Aussie is more volatile than the S&P, okay? So you can say to yourself, I might trade Aussie futures, Aussie yen futures, and you'll get a lot of volatility because look at how it moves, okay? But you see that it moves exactly the same as the S&P. When S&P goes up, Aussie goes up, okay? That's the story. Now, with that being said, we go back into the chart and we then add the value of the dollar dominance. And we say to ourselves, okay, then where are we at with the dollar dominance chart? New price scale. Okay, so what do I see? I see dollar is going up. Aussie is going down. S&P is going down. So if they're selling Aussie to put back into dollars and they're selling stock, it means that they want cash. That means they're seeking safety. Okay? What else can I put up there to help me understand the dynamics of the marketplace? Well, if I trade Aussie, what about Euro? Okay, let's put Euro up. Where am I in the markets for Euro USD? Okay, then. New price scale. What are they doing? Well, Euro's going down against the value of the dollar. That's pretty self-explanatory right there. Okay? And there's Euro right on the nose, dropping down. So I've got a clear correlation between dollar up, Euro down, Aussie down, S&P down, okay? We are now at a point in the chart where we would naturally be anticipating that dollar's going to try and come down and pull back because of how much it's been going up, and S&P is going to try and climb up again, okay? Remember, these are hourly charts, all right? But this is what you really want to be focusing on. Start your day off with going in the charts and saying to yourself, right, where am I? Where's the S&P? Where's the NASDAQ? Where's Aussie? Where's dollar? Where is everything right now? What's the general sentiment? Are they buying or are they selling? And when you have this snapshot in your mind, when you start your trading day, you can say to yourself, you know what? I think dollar's going to go down today. I'm expecting a recovery across the board with everything. Maybe that could be the case. And then you've set your tone for the day. Okay? Now, if you want to dive deep into the idea of the bonds and all of that stuff, okay, well, when we go into the 10-year bonds, right here, new price scale, look at that. What does this show you? This is the 10-year bonds, okay? This is the government bonds against the value of the dollar. Now, hear me out with this. What this is saying is investors aren't getting involved in treasuries, okay? They're not buying them up, okay? Or are they? Is smart money buying up treasuries? Because treasuries are going down, and we know that they buy when it goes down. So there could be investors that are right now investing in the treasury bonds as they are going lower and lower and lower and lower, okay? Because they want cheaper assets. They're cheaper on the basket of assets that the government holds. But then at the same time, you've got to then say to yourself, hold on a second, what about the US 2-yearly yield? Okay, so if I add the 2-year yield onto this chart right here, okay, hold on. US 2 O2Y, where are we at? Bonds. Oh, please. Where is it? Hold on. Oh, that's why. God, this is painstaking. Hold on. Here we go. I can see a clear inversion. 2-year yield is moving up. 10-year bonds are going down. Dollar dominance is going up. So now I'm looking at the picture saying, well, investors are trying to be coerced into investing with the government. That's why the yields are moving up. Because they're advertising, hey, look, you can get 4.425% with us if you give us $1 million. Happy days. The value of the dollar is going up because people are holding cash. Cash isn't being put to work. Okay? Now, just this chart alone is going to give you the heads up. Remember, the yields are inverted into assets. Yields go up, assets go down. Bonds go up, yields go down, assets go up. Remember that. When the 10-year bonds are going down, assets are going down, okay? When the yields are moving up, assets are going down. When the yields move down, assets are moving up, okay? In my opinion, this is the one chart you need to establish where you are in the markets. What's the tone? Do they favor higher prices or do they favor lower prices? What's the general sentiment? Have they been buying or have they been selling? Every pullback you see in the dollar dominance, is it just a quick profit taking? Quickly load up? Is the bigger picture suggesting that prices are going to drop across the board? You can see the concern of investors. Government ain't getting money from people. That's why they're offering 4.425%. When the yields go down, that means the bonds are going up. That means people are risk on, seeking the safety of government because they want an exposure by the government, a fixed return, happy days, minimal risk, and that's what will happen. Institutional fund managers will take their portfolios, okay? And then they will say, right, this is what we've got, guys, in our little pie right here, where 60% stocks and 40% bonds, okay? Now, what they'll do is they'll say, okay, what's our yields like right now? What are the yields offered at? Oh, they're offered at 4.25%. Okay, start taking out 40% of our allocation of bonds and start loading up in the government bonds. Start buying up this bad boy. This should be starting to work its way back up. Dollar dominance in principle would be looking at coming back down because they are now what? Putting the dollars to work, okay? Because they're exchanging. They're going to Aussie. They're exchanging dollars. And then they're using Aussie to buy assets like stocks, S&Ps, FX, gold, commodities, you name it, Bitcoin. If the dollars aren't being put to work, the value of the dollar is moving up because people are holding the dollars. That alone should get you set up for the rest of your trading day and have that information. Just understanding, firstly, main idea is where is the dollar in relation to the yields and the bonds is going to give you the sentiment of what traders are thinking. You can even throw the volatility index in that as well, okay? Just to make life even easier. Where's the volatility index? Volatility index is all the way up here. Happens to be with what? With the yields. Happens to be with what? With the dollar. What does that tell you? That tells you that investors are in fear. There's a problem. Things aren't looking too good. The volatility index is moving up. Yeah? Likewise, when it's inverted, you can see that when the bonds are going down, okay, look at how the bonds have been going down and the dollar dominance has been climbing up, okay? There is a relationship between it all. But don't get too deeply caught up into this. Use it as a snapshot. Say to yourself, okay, what do I see today? Okay, look, well, bonds are up. Well, bonds are down. Yields are up. Dollars going up. I think everything's going up today against these. I think everything's going down today because people aren't favoring risk. That's it. And then you go to the charts and try and exploit that. Okay? I hope that makes sense. And if it answers your question, my friend, please let me know. Okay? Mad love and respect. Peace.